Welcome to Simple Investing Secrets. In this video, we will review 12 massively undervalued stocks that can make you a millionaire. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. A market downturn will always be the best time to look for undervalued stocks, and this will hold true in 2023 as well. Investors should seize this once-in-a-generation chance to buy oversold stocks before the economy starts to pick up steam again, given that the S&P 500 has lost nearly 18% of its value so far this year. In this difficult environment, a lot of good companies are being sold at significant discounts as worried investors move into more defensive assets. Some of these companies have solid fundamentals and they will continue to be relevant for years or even decades to come. When the economy eventually picks up steam, shareholders who purchase shares of these sharply discounted companies will be the ones to profit. It can't be a coincidence that some of the most renowned and successful investors are contrarians who made purchases when everyone else was making sales. In this challenging environment, many solid companies are changing hands at significant discounts as alarmed investors seek out more defensive assets. Of course, it is impossible to predict when the market will bottom. It still has room to fall from here. However, buying oversold stocks is guaranteed to pay dividends if you plan to hold them for a long time, so you shouldn't be concerned about temporary losses. Most predictions say that the Federal Reserve will change its mind next year and change the way it handles money in 2024. The following 12 deeply undervalued stocks are set to take advantage of the ensuing bull market. Let's review our list. Number 12. Netflix, ticker, NFLX. Like Alphabet, the tech sell-off hit Netflix quite hard. The company had to compete with its 2021 metrics to appease investors, resulting in NFLX nosediving 73% below its peak within 6 months. However, investors are soon realizing that Netflix is performing much better than its peers. The platform has retained most of its subscribers from the pandemic era, and its finances are doing much better despite the decline. For example, Netflix posted revenue of $5.5 billion in Q4 2019, which is now almost $8 billion and still growing despite headwinds. Over the trailing 12 months, the company's net income has gone from $1.9 billion to over $5 billion. Moreover, Netflix's subscriber count stands at 223 million, up from 167 million. Perhaps the only significant metric for Netflix that's below Q4 2019 levels is its stock price. Furthermore, Netflix is still cutting costs and plans to increase its profitability through ads. It is also getting more strict with password sharing, which can also increase its revenue over time. Investors recognize the opportunity, and NFLX stock has crept up 72% from its lowest point this year. Even then, this stock has more upside as it remains well below pre-pandemic figures. Number 11. Meta Platforms, ticker, META. Due to their significant investments in the metaverse, many people view Meta Platforms as a falling knife, but investors need to dig deeper. The metaverse may only excite a small number of people, but the company is much more than that. Meta owns Facebook, Messenger, Instagram, and WhatsApp. We don't think that a company with so many popular platforms should be worth $295 billion. The metaverse project is far from unsustainable. So far in 2022, Meta has made $32 billion in operating profits from the family of apps, while spending $9.4 billion on Reality Labs. The company is also far from being unprofitable. Additionally, Meta has announced layoffs, much like other tech companies. That should help its bottom line stabilize until advertising revenue picks up again. Number 10. Apple, ticker, AAPL. Apple has a solid business that will remain relevant for the foreseeable future. It is also much more resilient than other tech companies, as it continues to expand its workforce despite the market downturn. While most other undervalued stocks in the tech industry heavily rely on advertising revenue, Apple does not. As a result, the impact of declining ad revenue has been minimal for Apple. In addition, higher income folks make up the company's primary customer base. They are not as affected by high inflation, which is why Apple's sales keep going up. The company beat estimates, with revenue growing 8.1% year over year this past quarter and net income rising 0.8% compared to last year. These metrics certainly justify its current premium price-earnings ratio of 24.5 times. Investors in this market find stability and growth prospects compelling. Apple has both. It has shown exceptional resilience among FANG stocks, and its sales have a lot of room for growth. Apple's market share is still low outside the US and Europe, but these fast-growing economies could become major markets for Apple products over the long term. Number 9. Microsoft, ticker, MSFT. Microsoft is another one of the undervalued stocks we think will remain relevant in the long run. The company's products are too entrenched in people's everyday lives, and it is now almost impossible for white-collar businesses to run without Microsoft products. This ensures the company will have inelastic demand for a long time. Microsoft's profit margins have taken a hit, much like those of most other companies. However, the current downturn presents a very compelling buying opportunity. When margins recover in line with the broader economy, a strong move to the upside is only a matter of time. Microsoft's top line grew 10.6% year-over-year to $50.1 billion, mainly driven by its cloud segment, which is now Microsoft's top source of revenue. Azure and other cloud services grew 42% in constant currency terms. Thus, when its bottom line starts to recover, investors willing to pay more of a premium for MSFT stock. Number 8. Home Depot, ticker, HD. The Home Depot, which is down nearly 25% this year, was recently at its lowest level since before COVID, making it one of the undervalued stocks to buy before its big comeback. The drop in share price doesn't make much sense when you consider that the Atlanta-based company just reported good earnings for the third quarter 2022. Home Depot continues to manage inflationary pressures. The company has been focused on serving professional home builders and contractors rather than putting its efforts toward serving do-it-yourself renovators and weekend warriors. The company's sales to professionals continue to exceed its revenue from do-it-yourself projects. The strong earnings show that Home Depot has been unfairly dragged lower by this year's market rout. Add in a PE ratio of 19 on HD stock and a quarterly dividend that yields 2.38%, and it's easy to make the case that investors should buy HD stock on the dip. Number 7. Target, ticker, TGT. Target is a dividend aristocrat, having increased its dividend payout to shareholders every year for almost 50 years. After a banner year in 2020 during the start of the COVID-19 pandemic, the company increased its revenue again in 2021. Inflation and changes in how people spend their money hurt its profit margins in 2022, when people started spending more on necessities instead of big-ticket items. The longer-term potential is still there for Target. Best known as a big box store, Target has transformed itself into a one-stop shop that sells everything from groceries to basic household goods. Target also has its own brands for things like clothes and home decor that are usually sold in department stores. Additionally, almost all U.S. residents live within 10 miles of a Target store, helping the retailer to turn its locations into distribution centers. Some 95% of all orders, including many placed online and shipped to customers' homes, are now fulfilled by local stores rather than distribution centers. Target also offers curbside pickup and is expanding its ship delivery service. Target plans to spend about $4 billion a year on capital improvements over the next few years. The spending will be used to open new stores, remodel existing stores, and improve supply chains, a sharp increase from the approximately $2.7 billion it allocated annually from 2016 to 2020. The company also plans to grow its e-commerce business and keep paying a reliable dividend. The company's stock still trades like it is only a brick-and-mortar retailer. Target is implementing a multi-pronged strategy that effectively leverages its physical footprint. E-commerce pure plays are all the rage, which also contributes to Target stock being undervalued. Number 6. Amazon, ticker, AMZN. Amazon, the first company to sell things online, settled the question of whether or not its huge business could ever make money years ago. It's been quickly and steadily churning out higher rates of net income every year. But the company has increased its spending for 2022 to increase its lead in e-commerce and keep growing in the economy. As a result, Amazon may not be the first name that comes to mind as an undervalued business. This is, after all, still very much a growth stock. Amazon is lapping up the early pandemic boom it enjoyed in 2020 and 2021 when online shopping activity was elevated. As it laps these results, e-commerce revenue growth has slowed to a single-digit percentage pace. But the cloud computing segment AWS is still firing on all cylinders, and profits from AWS are being reinvested into data centers and other digital services to foster even more growth. However, regulatory concerns have cropped up. Some people worry that Amazon's e-commerce, cloud computing, advertising, and other businesses that work together could put it in the sights of government regulators, just like some of the other big tech companies. Whether that happens remains to be seen. Either way, Amazon is starting to look undervalued given its enduring growth trajectory and long-term potential. The stock's price is about even with its price in the summer of 2020 even as Amazon's massive reach has continued to expand. Number 5. JP Morgan Chase, ticker, JPM. Retail financial services and investment banking giant JP Morgan Chase has nearly $4 trillion in global assets. It's a banking behemoth that maintains a tiny presence in many U.S. cities. The bank has an international footprint and is rapidly expanding its presence, especially in emerging markets where banking services are not easily accessible to many people. JP Morgan is particularly active in China. JP Morgan is aware that digital banking is trending among young consumers. It offers various apps to help clients manage their cash and debt, and it prioritizes the mobile experience. The company is facing plenty of competition from technology companies seeking to make inroads into the massive financial services industry, but it's proving its ability to evolve. JP Morgan also has plenty of other levers that it can pull to drive growth. JP Morgan Chase stock has fallen sharply in 2022 on heightened fears that the economy could slip back into recession. Shares trade like other traditional banks even though the company is competing in the technology space. Pure-play fintech companies trade for much higher premiums, but this massive bank will continue to strongly perform as consumers increasingly use mobile devices to manage their finances. The stock looks cheap for its long-term potential and dividend payout after a tough year. Number 4. Alphabet, ticker, Google, and GOOG. Internet conglomerate Alphabet is a ubiquitous name in tech. Google search is used every day by hundreds of millions of people all over the world. YouTube is the world's most watched video service. And Google Cloud holds a lot of promise as cloud computing becomes the norm in IT. 2022 has not been kind to Alphabet stock. Much of the business is still closely tied to advertising, and organizations tend to cut spending on ads in difficult economic times. As a result, shares have sold off hard on worries that Alphabet is headed for a lean year, although the ad industry has continued to grind higher through the first half of the year. Longer term, global digital advertising spending could hit $1 trillion annually by the end of this decade. Many estimates also point toward cloud computing reaching $1 trillion in annual spending in the next 10 years. These projections put Alphabet in front of multiple secular growth trends, an excellent position to be in for investors who want to park money on a surefire stock for the foreseeable future. Nonetheless, Alphabet stock is trading near its all-time low in some metrics. Alphabet also has some of the deepest pockets around, with more than $100 billion in net cash and investments. Alphabet uses its cash hoard to invest in emerging tech such as its self-driving car startup Waymo and to repurchase stock. The tech giant is a top undervalued buy for 2023. Number 3. Disney, ticker, DIS. When we talk about cloud computing, the Walt Disney Company is a great example of a company that isn't in tech but does a great job of using technology. Its 2019 launch of Disney Plus marked the company's entrance into the streaming TV market. By mid-2022, the service had more than 150 million subscribers, plus millions more from ESPN Plus and Hulu. Within the next few years, the customer base for Disney Plus, marketed as Disney Plus Hotstar in many markets outside the US, is expected to increase to hundreds of millions, putting Disney Plus on the path to overtake Netflix as the world's largest streaming service. Disney Plus is certainly not undervalued since investors are already aware of its long-term potential, but the rest of Disney certainly could be. The company's flagship business, which was a theme park, stopped making money in 2020 and was a huge drain on profits until 2021. The same goes for its film business since new movie releases were delayed or sent directly to the streaming service. The global economy is still finding its footing amid ongoing pandemic-related challenges. But consumer travel is making a big comeback in 2022, especially in the US. International travel is still depressed internationally, but domestic vacations are boosting Disneyland and Disney World. Trips to the theater are making a comeback, and Disney's Marvel superhero franchise in particular is helping the entertainment giant turn a profit from filmmaking again. With some of the most beloved entertainment franchises in Disney's stable and multiple ways to monetize them through its vertically integrated operations, the company's non-streaming businesses have plenty of upside potential. Disney stock looks undervalued for 2022 and beyond. Number 2. Qualcomm, ticker, QCOM. When it comes to semiconductors, Qualcomm is a commonly understood name. Almost every smartphone on the planet has one of Qualcomm's chip designs in it. Qualcomm still has a lot of power over everyday mobile devices. About 85% of the world's smartphones use Google's Android platform. 5G mobile network deployment is still going strong in most countries and has consumers rapidly upgrading their devices to take advantage of 5G. Qualcomm is finding plenty of new growth outlets for its hardware, such as industrial equipment that needs a mobile connection. The hardware that generates wireless signals and enables devices of all kinds to connect to it is networking equipment, which is another area. The automotive segment is growing rapidly. Qualcomm has quickly gone from virtually no auto industry sales to generating more than $1 billion in annual revenue. As technology makes more inroads into modern vehicles, Qualcomm sees its auto segment doubling over the next few years. From wireless connectivity to processors controlling advanced driver assist systems to actual software operating systems, Qualcomm has automakers covered with a robust tech lineup. Working from a position of strength in mobile computing, Qualcomm has been reinvigorated lately as chips proliferate throughout the global economy. It's a top name in the semiconductor business, one that is often overlooked and trading at a discount relative to many of its peers. Number 1. Shopify, ticker, SHOP. It's an understatement that 2022 has been a devastating year for e-commerce companies. For Shopify, this has certainly been true, with the company's stock price plummeting more than 70% from its peak. Shopify has suffered due to logistical issues and high inflation. However, those issues are not permanent, and the stock can be a multi-bagger in the long run. It's easy to see Shopify as among the best undervalued stocks when compared to its pre-pandemic metrics. The financials of the e-commerce company are merely shifting to a more natural growth trend. Shopify will appear to be a failing company to investors if their financial data is compared to that from 2021. However, investors should realize the long-term opportunity for Shop stock remains robust. Once the business starts to turn a profit, we think the price of Shop stock will soar significantly. With losses decreasing, that doesn't seem all that far away from this accomplishment. This makes it one of the best undervalued stocks to buy at the moment. Stocks that are undervalued have shown they belong in a diversified portfolio. In fact, few stocks offer investors the opportunity to access more potential than those with significant room for growth. Proper due diligence will reveal many undervalued stocks in today's market, but for those of you with less time, the equities discussed in this video should be a good place to start. This concludes our list of the 12 massively undervalued stocks that can make you millions. Don't forget to like our video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investing strategies for building wealth. Thanks for watching and best of luck with your investment.